Hello there. Welcome back to my channel. In this video, we are to look at the calculation of insurance claim, whereby we are going to look at a question from the question paper of November 2023. So we are going to go through our question, which is our question 4 on that question paper. Sales at a profit markup of 55% of cost price with all the inventory, except inventory to the value of 18,700 rands. This inventory was insured for 110,000 rands, and the average we are being informed that the average clause was applicable. So we are also going to come up with the average clause, whereby we are going to say insured amount divided by closing inventory, and then we multiply by inventory loss. So as the question progresses, it reads on December 2020. So we have got further information given according to the question that you just need to go through before you start. It's almost Sunland Insurance Company. So this is what we have. So the formula that we are going to use to calculate inventory loss, we are going to calculate inventory loss as so basically, this is going to be our formula for calculating inventory loss. That is inventory closing inventory minus salvage. So remember, destroyed runs. So we want to find the value of the inventory that was destroyed. So it's the inventory amount of inventory that remained after the other inventory was destroyed. So we are given it as 18,700. That is the remaining inventory. That is the representation of our salvage. So basically, this is what we have. So the closing inventory, we are going to calculate it in the trading account. So we are going to have our trading account where we are going to calculate our closing inventory. So according to our trading account, remember on the debt side, we are supposed to have our opening inventory. We are also supposed to have our purchases on the debit side, and any transport costs in terms of import duties, any carriage inwards, freight on purchases should be on the debit side. And obviously, gross profit also should appear on the debit side. Then on the credit side, we are going to have our sales, and then we also have the figure for our closing inventory should be on the credit side. So basically, this is what we. So we're going to start with our opening inventory. So the figure for opening inventory, we are given in the part, we are given that inventory on one chart. This is going to be our opening inventory is 43,700 rands. Then so on our purchases, you can put your purchase on the debit side and then purchase and tails on the credit side, or you can just calculate the net purchase figure that you put on the debit side, whereby you say the purchase amount minus the purchase and tails. If the purchase and tails are given in the question, so if you refer back to the question applied, we're 32,000. So we can subtract 32,000, 162,000 rands. Purchases amounted to 162,000 rands. So we're going to say 162,000 rands minus 32,000 for the 10. Then I subtract, you get your answer is 130,000. So having that now, we are also supposed to check if you've got any transport costs on purchases. That is in terms of our import duties. So if you come here, you'd see that we are given your figure is the cost for import duties and freight amounted to 6,700 rands and 8,500 rands in spot and freight is given. So we can as well put them on the debit side whereby you put import duties. So the figure for import duties that we have, we can just refer back. We're given it as 6,700. Then we also have the freight on purchases. Then the freight on purchases figure that we are given, you're given it as 8,500. So basically, that's what we have on that part. And we are also supposed to have our gross profit at all. So for our gross profit, for our gross profit, what we are going to do is we are going to calculate separately the figure for gross profit and input it there. And then the figure for our closing inventory, we can as well find it as a balanced figure. So we go to entries that are supposed to be on the credit side. So on the credit side, we are supposed to have our sales, whereby we also on the credit. Then if you have got sales returns, you put them on the debit side, or you can just calculate the figure for net sales, where we're going to say the total sales minus our sales returns. So going back to our question, we're going to see that the figure for sales we are given it is the sales amount was one is which we have is 6,310. So we can just calculate the net sales figure by saying 195,600, and then we subtract 6,310. So we are seeing 195,600. Then I will subtract our 6,310. Here's our returns, 290. So having that now, we are also supposed to have your closing inventory on the side. Closing inventory, if we have found our figure 4, then we can now we have our figure 4 closing inventory as a balancing figure. So our figure for our total gross profits, we are going to find it separately, whereby we are going to say so the figure for total gross profit, we are going to find the gross profit on normal sales, and then we are also going to add the gross profit on yield sales. Then if you are also given staff sales in the question, you are also supposed to calculate gross profit on staff sales. But within the context of this question, we only have a gross profit on normal sales, and we also have a gross profit on yield sales. So we're going to say so basically, this is what we have, whereby we add the gross profit on normal sales plus a gross profit on yield sales. So firstly, we are going to calculate the gross profit on normal sales. So if you refer back to as 195,600, but you'd see that inside our normal sales, inside our total sales, we also have the yield sales where during October 2020, where inventory at the value of 42,300 rands sold at the market price less at 25%. So basically, we have got also sales of 42,300 of yield sales, so total sales figure, so that we get the figure for normal sales. So we are going to say 195,600. Then we subtract our yield sales, which is 42,300. So if you check again, remember we've got the tens that we have sales in terms of 6,310. We have our the figure for our sales. So we also subtract our sales returns, which is 6,310. So we calculate it like that. You see that the figure that we are going to get, we can just try to see what figure are we getting. We're going to get your figure as 146,990. So basically, that's what we have on that part. And then this becomes your normal sales. So to calculate our growth at the beginning, at a profit markup of 55% on cost price. So basically, remember, we are going to use the formula gross profit. So we're going to say cost price plus markup. Obviously, markup is the gross profit. And then you are going to get your selling price, where the cost price is always 100%, and we are given it is 55%. So you add the two, you get a total of 155%. So basically, this is now the representation that we have. So according to the question now, you can now use a simple proportion because it seems that there are 90 runs, which is equal to the sales 100 and 55. So the figure that we are looking for is the 55% for gross profit. So it's obviously going to be a question mark, and then we can try to use our proportionate calculations so that we can find the figure for gross profit. So it becomes what we don't have is 55%, so it becomes the numerator, and what we have is 155%, which is 90. So if we calculate it like that, you see that the figure that you're going to get is of gross profit for normal sales to two decimal places. It's going to be 52,157 rands, 74 cents. So let's see. So this is the figure that we have, which represents our gross profit on normal sales. So with that now, remember our formula is saying gross profit on normal sales plus gross profit on yield sales. So we are now supposed to calculate gross profit on yield sales. Whereby, if you refer back to the question, we are told that the business had a sale of inventory during October and 300 rands, sold at the market price less 25%. And then if you subtract 25%, you are going to get your other 75%. So basically, this is what we have. So it means it was sold at a proportion of 75%. So basically, what we are saying is that this figure that we have is of 42, that is the 100%. That is the normal market price before the reduction of 25%. So basically, if you come now there, you just make again a simple proportion whereby you say 75% is equal to 42,300. And the figure that we are looking for is 100%. The question mark. So basically, number is 75 times 40,300. So it becomes so you calculate it like that, you see that the answer that you are supposed to get is 56,400. So 56,400 rands now represents the market price. So this is the market price, the price that was supposed to be before the reduction of 25%. So this is the market. So from there, we can now be able to calculate cost of sales. Remember what we want to calculate. We want to calculate it like we are supposed to say we want to calculate our gross profit as gross profit is equal to our sales minus our cost price. So basically, according to the information given, we now know that this was supposed to be the market price, so we can now be able to find the cost price. The sales we already have it is 42,300, so we want the cost price. So we already know that the representation in terms of cost and markup it's 55% our markup to get our selling price of 155. So basically, what we are going to do now is the representation that we have. This is going to be our 155. 56,400 is going to be 155, and you want the figure for 100%. So basically, that represents now our cost price. So we are going to say our 155 percent, our 155% is equal to our 56,400. And then the figure that we are looking for is 100%. So from there, we can now be able to calculate our cost price, which is represented by 100%. Remember, we said our 100 plus 55%, 100 plus 55% to get our 155%, whereby we're saying this is the cost price, and then our cost price plus our markup equals to our selling price. So basically, this is what we so the cost price is a representation of 100%. So on our calculation, we are saying what we don't have is 100%. So we calculate like that. You see that you're going to get your answer is 36,387 rands 10 cents to two decimal places. So basically, this is the cost price. So remember, to get our gross profit on yield sales, we are going to use the formula. Sales, we are given it as 42,300, and then we subtract the cost, which is 36,387 rands 10 cents. So we are now saying so basically this is how we are going to get our gross profit. So we calculate, we see that the gross profit on yield sales is going to be you are going to get your answer as 5,904 rands 90 cents. So to get our total gross profit, so total gross profit, we are now going to say our gross profit on yield sales, which is 5,912 rands 90 cents, and then we add gross profit on normal sales, of which gross profit on normal sales we found it as 52,157 rand 74 cents. So basically, this is what we have. So we have that figure here. So you add the two, you are supposed to get your total gross profit as 58,070 rands 64 cents. So this is the figure that is supposed to come to our trading account and replace our gross profit. So this is going to be our gross profit in the trading account. So we go to the trading account. This is the figure that is supposed to come here. Is 58,000. So we have 58,070 rand 64 cents. So obviously, if you check according to our trading account, it shows that at the debit side, obviously, it's going to be a greater total. If you add the debit side, you're going to get a total of 246,000. 246,970 64 cents. So this is the same figure that is supposed to come to the credit side. And then we now are supposed to find the closing inventory as the balancing figure by saying 246,970 rand 64 cents minus 189,290 rand. So you get your balancing figure is 57,680 rand 64 cents. So this becomes the closing inventory. So I remember to calculate the closing inventory now we have it and the salvage is 18,700. So inventory loss so our closing inventory is 64 cents. Then we subtract the salvage, which is 18,700 rands. So you calculate there, you're going to see that the inventory loss amount is going to be 38,980 rands 64 cents. So this becomes your inventory loss. So if you refer back to the question, you're going to see that it reads that his inventory was insured for 110,000 and the average clause was applicable. So we are going to calculate the average clause, whereby we are going to say average clause is going to be equal to insured amount over closing inventory and then you multiply by the inventory loss. You multiply by the inventory loss over 1. So on our calculation, we already have all the figures whereby you're going to say insured amount you're given in the question, which is 110,000. The inventory was insured for 110,000. So we have 110,000 over closing inventory, which we have here is 27,608 rands 64 cents. And then you multiply by the inventory loss, of which the inventory loss we've calculated it, we got 38,980 rands 64 cents. So calculate it, you're going to get your figure. Average clause is 74,338 rands and 12 cents. So it means our average clause amount is 74,338 rands 12 cents. So basically this is what we have, and then the insurance claim is at 38,980 rand 64 cents. So basically, I say this is the insurance claim. So basically, this is what we have according to this video, and thank you for listening. Let's meet again.